Good afternoon. Hope you're doing good. Today will be a brief rundown of what has taken place in the marketplace today, what I saw, and a bit of a workshop on price action. So generally, straight into it's going to be a quick one. I've actually recorded a video, but there was no sound, so it's quite disappointing. But I'm going to have to quickly run through this one. So we can see that we're in an uptrend. We are trading at all-time highs. I'm going to be touching on daily bias, touching on profile, daily profiles. I'm going to be touching on liquidity, and I'm going to be touching on how to trade all-time highs because there's literally nothing to the left to aim for. Usually, if you had maybe sell side taken, maybe you could aim for these highs, and ultimately these highs. Same thing here. Inefficiency, you aim for these highs, sell side taken on this retracement, you can aim for these highs, these highs, these highs. But trading this is a bit complicated, it's a bit confusing, it's a bit scary. Is it gonna retrace? Is it gonna um how far can it go? Do I take profits? I'm gonna touch on all that. Just stick with me. Hopefully we can do this in 10-15 minutes, straight to the point, no bullshit, right to the meat. So straight away we can see that we're in an uptrend. The market clears liquidity here, rallies back up, fills all of this, rallies back up, retraces back into inefficiency, rallies up. And I'm going to drop down to the hourly time frame. And first of all, I'm going to mark out my midnight open. You should have this marked out on your charts. Every time you put on your chart to trade, you should have the midnight open at New York time marked out. I'm going to mark out the Sunday opening price right there. So straight away, we can see on the hourly time frame, liquidity has been taken down here, rallies up. There is no inefficiency down here to for price to retrace back to. This has been retraced back into already, sell side liquidity taken. So there's going into Monday. Today is the 17th of June 2024. So going into Monday already, you can see that there's nothing for price to retrace back to. So you're already going into the day with an idea that I'm not expecting much of a retracement, but I'm expecting a Judas swing anyway. What do I mean by Judas swing? For those of you that are new here, actually, I'm just going to extend the midnight opening price on the chart. So you should always have this while trading. If you're starting out, even if you're seasoned, you've been at this for a while, you should have your midnight open marked out because the best buy setups, the best time to be a buyer, the best place you can be as a buyer in a bull market is below the midnight open. I'll say that again very slowly. The best setups will happen. They will form your fair value gaps, your inefficiencies, your rate on liquidity will happen below the midnight opening price of New York time. That is where you want to be a bull in. That's where you want to be a bull, below the midnight open. So you have the daily profile. So if we are expecting higher prices, like we've outlined on the higher time frame, we are expecting price to rally higher. The price opens, rallies down, creates a Judas swing. That's all of this here. A fake swing, a trick, a false breakout to the downside to trick people to chase this, to run after this, to engage with this, to stop people out that have thrown their stop loss up here. Rallies down, makes the low of the day, then rallies back up to form the expansion, to form the daily range, makes the high of the day, then near the closes near the high. So that is your classic buy day, your classic bullish that's your classic bullish day. If you're looking for higher prices, looking for an expansion to the upside on the daily, that should be your guide going into the trading day. You're looking for higher prices, you're looking for a manipulation down, you're looking for an expansion to the upside, and then distribution at the top and price closes near the top. So I'm going to drop down, having this in mind, I'm going to drop down to the 15-minute time frame straight away. It's going to be quick. So you can see this low right there. I'm just going to move this a bit. So you can see this low. So the market opens on Sunday, yesterday, and it makes this low. Trades, makes this low. This, I want to draw your attention to this low right there, and why I have why I give preference to this low. The London session, the London AM session starts from 2 a.m. to 5 a.m. New York time. And what time did this low form? Look at the bottom axis. What time did this low form? Right at the middle of the London session, right at the start of London session. So the London AM session will be from 2 a.m. to 5 in the morning, New York time. And then the New York AM session will be from 7 in the morning, New York time to 12 p.m. New York time. Right there. There we go. So you should have these things on your charts annotated already. So it's going to guide your analysis. So we have this low right there. So there's sell side below lows or relatively equal lows. Sell side liquidity right there. So how do I know there's liquidity below this low? It forms a low, rallies away. Now, all this while we are not trading, we are not even looking at the market at this time. We come to the market at these periods. Maybe if you're a London session trader or a New York session trader, we see oftentimes I do not have anything against trading the London session. I do not, if you trade the London session and you're finding it good, that is lovely, stick with it. But oftentimes, the New York session tends to a very provide the upper hand in a sense that what do I mean by this? So throughout London, we see London rallies, rallies a bit to the upside, but New York then takes out the London low and then rallies back up. So having trading New York session gives you the benefit of hindsight and allows you to see what the Asian session has done, what the London session has done, and what the time after the London session, what's happening in the market. So that gives you more context. It gives you something more to work with in terms of information from the market and framing an idea. So you can see a low formed. So now retail will see this as support and like, oh yeah, this is good. It came down here, it rallied off it, so it's good. Is a is a support zone. It's going to support price, but that's not the case. In fact, you see price rally to and through here. We're going to get to that in a bit. So I like this low because I like this level for sell side liquidity because from the low came very close to the low, very close, but didn't take it out. That is suspect. That's something for your notes. That is very suspect. When you're looking for higher prices and you see a low form, and price comes very close to that low but doesn't take it out, it's very suspect. Oftentimes, price will revisit that and clean it up very well before you can see the big moves happen. There has to be someone stopped out. So, going into the New York session, we see the market open at 9:30, and at 9:30, so a tip, something for your note, something to add, something to something for you to to even add to your understanding. When you have the London session and it really is not clear what's trying to do. I mean, it's broken to the upside, but then it's broken down to the downside again. It's broken again further down, but it did break up. So it's choppy. It's not one way. It's not one directional. So it's a bit confusing what the London session is trying to do. When you have a situation where London session is a bit choppy, maybe you had a loss or it's not clear what price is trying to do. Wait until the New York AM session. Oftentimes, you will get the full picture, you will get a clearer picture, or you get a better feel for what price is likely to do next. So dropping down to the 5 minute time frame. So what does the model say? When we are bullish, I'm going to just put this down here. When bullish, you're looking for a raid on sell side liquidity. The first thing you must see first when you're looking for higher prices, a manipulation leg down, a raid on sell side liquidity in the form of a low or relatively equal lows. You want to see that raided. Once that happens, you want to see displacement. Does price displace from where it currently is? You want to see strong displacement. You want to see displacement. How do I know the market has displaced? Now, looking at the raid on liquidity, check. We've had that one done, and it raids it during a key time of the day, during the New York kills on the New York AM session at opening bell. Good. How do I know the market has displaced? Now, pause the video and looking at the raid, and looking at what's happened afterwards to the right. How do I know that the market has displaced? Pause the video, have a go at it, try and identify where you think, or what makes you sure that the market has in fact displaced and smart money has come in. Pause the video, pause the video. You're not pausing the video. Okay, so straight away it's a market structure shift right there. So when we have a market structure shift and a fair value gap right there, you can trust that's the market literally tipping its hand to you. I'm about to go up. I'm about to explode to the upside. I'm going to look for higher prices now. Get on board or be left out. That's literally the market telling you I've broken structure to the upside. So a market structure shift is when you have a candle, one sec. When you have a candle, a high, a higher high, you have a higher high to the middle and a lower high to the left of it. Once you have this, that is your swing high. Once this is broken, once price trades through this, that is a market structure shift, and we have that right here. That's your shift to market structure. So hang on a sec. So once that happens and we have a fair value gap, that's displacement. Imagine an elephant stepping into a pond or water, or imagine a bomb falling into a water. You cannot miss it. It is going to show itself. They cannot hide this from you. When trading, they can't hide this. That's your sign that smart money has actually in fact stepped into the marketplace, and you can start looking for your long setups. Now the fact that you've had sell side liquidity rated, that's good. You have a displacement, and how I know it's displaced, fair value gap, good. Then you have your market structure shifts. Then and only then you look for a retracement back to inefficiency. An inefficiency can be in the form of a fair value gap, an inversion fair value gap, a volume imbalance, whatever of them, whichever of them you want to use. I'll have a video covering each of them separately, but this is just a very animated example of everything crunching together and being in play, and the setup actually being there, and me walking you through in my own point of view. So we have one, sell side taking good; two, a displacement with a fair value gap, a market structure shift; three and four, a retracement back in to an inefficiency, which is in the form of this fair value gap. And you hold that, you can be a buyer in here. Price rallies up, it retraces back in, you can buy here one more time. Why can you buy here? Remember what I said, the best long setups will happen below the midnight open. So where price opened, the opening price for that trading day, today being Monday at 12 midnight, that opening price, remember, back to this diagram, it's a bit big now, but the market opens, rallies down. The market will only go down to go up. This is the Judas swing. This is what would trick the newbie traders to go short and to chase this. You do not chase this. You actually want to see this happen before you go long. Once this happens, your high probability buys, the good buys, what you're looking for will be in this lower portion of the daily range. This lower portion, this wick. It doesn't look like a wick here, but on the daily time frame, that's what is. This represents everything below the midnight open. So all this below is summarized in this wick. So price comes down and comes back up. This is a wick on the daily time frame, but on the smaller time frames, you can see they're actually full body candle. This is where this is where the best buys will happen, below the midnight open. So that's literally it. Nothing too crazy. It's literally that. So you're looking for four things when bullish: a raid on sell side liquidity, a displacement with fair value gap, market structure shifts, a swing high broken or swing high is broken, then you're looking for a retracement back in, so an inefficiency, and then you can go long from there. How do you know how to target? Now, this is the bit I promised I would add in the end. So when targeting, you target when bullish, you target old highs. So look at this smooth highs above there. You can target that. Look at this singular swing high here. You can target this. And now after this, there is nothing else to target. There's nothing to the left again to target. So now this is where you take your partial. So if you maybe went in with 5 lots, you could potentially take 3 off at this level and see if you get a runner, because one, remember, you're trading at all-time highs. So reduce your expectation in the sense that it could reverse from here. You do not know that. Remember, you don't know. You're not trying to sell at the very high and buy at the very low. Although this this is very close to buying at the very low, but you would want to enter on the fair value gap. Where would your stop loss be? Your stop loss would be below this candle. The first candle in the fair value gap formation. One, two, three. Below this candle, that's where your stop loss would be. As you can see, it's a very safe stop loss. So if you trade to your stop loss, when using the fair value gap, you're probably wrong and you should sit on the sidelines and wait for more information from the market. Don't jump right back in. And yeah, so take a partial off here, because it's logical to take a partial above old highs because you're buying below old lows and you're covering your position above old highs. It's simple logic, and you can hold your trade and see if maybe the remaining positions you have left, you can get a runner, and as you can see that we get a massive expansion to the upside. So how do I know how far it will expand? How do I know when to close the trade? I mean, it's going up. It's like, do I close the trade? But if I close it, it could rally more. That's okay. That's where you have to manage yourself. You have to be disciplined as a trader. Take what you see as okay, take it and be done with it. There's always another opportunity to trade. So I'm just going to add in a bonus in terms of targeting and how to target, and you know reasonable levels to target, when especially when you don't know how far the market is likely to trade up in these kind of difficult scenarios and all-time high cases when there's nothing to the left to refer back to. There's no swing high to refer back to. It's literally just empty. So I normally use a fib. I use my fib to kind of project and see where I can mark out for targeting. So if you look at, so your fib, to use this, to look at the price leg that raided sell side liquidity. So that's this leg right here. So at 9:30, the market opens, rallies up, then rallies down. Right there. That is the leg. That is the price leg that swept liquidity. So now you take your fib and you anchor it to the low of that price leg right there and stretch your fib to the high. So you want the 0 level to be at the low, and you want the first standard deviation to be at the high that caused that raid on liquidity right there. The moment you do that, I'll have my fib settings so you can take a screenshot of that. But I like to use the fourth level, the fourth standard deviation in terms of targeting. Like, this is my best case terminus. Once it gets to the fourth standard deviation, I'm no longer interested in the move. I feel it's over protracted, it's overextended, and I'm not willing to stick around because I don't know when it will retrace, which it did do here. So once it gets to the fourth standard deviation, I'm very okay. I'm usually very content. It's massive profit, this expansion, and it's very satisfying. So getting to the fourth standard deviation is your best case scenario, but you can still take partials along the way at these levels. So I'll have a screenshot of my fib settings. So this is the settings I use for my fib on TradingView. You can take a screenshot of that, take a mental note of it, take a screenshot, take a picture. This is what I use for targeting when I'm not I use this for targeting when there is nothing to target for, and it just helps with managing my expectations for a price run and seeing where the market is likely to reach for in terms of a range or an expansion to the upside. So hopefully you've taken a screenshot of that, and I hope you found this insightful. Just a quick recap. When looking for higher prices, you're going to get tired of me saying this. you're looking for sell side liquidity to be raided. So sell side liquidity will be in form of a low or a group of very close, relatively equal lows in close proximity. You're looking for that to happen. Once that happens, now you're waiting for a displacement. How do I know the market has displaced? When there's a fair value gap right there. I'm going to take this off real quick. A fair value gap right there and a break in market and a market structure shift to the upside. That confirms my displacement and my market structure shift. The moment that happens, the moment I see this 1, 2, 3, automatically there is a potential for a trade idea. I'm looking for a retracement to a fair value gap in a discount is below the market open. It even comes back down to that very discounted sell side liquidity level. So everything is in play in the sense that there is liquidity resting above here and above here, and ultimately using the fib targets I've outlined here, which you use for taking partials. So you can see how everything blends together in one to frame an idea to go long, to actually interact or to take part in this move to the upside. So a lot has been said. Like I said, this video is going to be brief, about 20 minutes. I don't think that's long. Hopefully you found this one insightful, and go over the video, watch it, take some notes, because I will be building on this as we move along. So this is just an example of me walking you through what to see, pointing things out to you, because you need this when you're starting out. You need this guidance, you need me to lend you my experience when you're starting out, because it's going to be very beneficial. And over time, given enough practice and enough dedication, you yourself will be able to see these setups in real time as they happen. You'll be able to spot them in past data, like, oh, this is this, I remember this, I remember that, oh, this did this and did that. That is something you have to go back in your charts. I would advise you, after watching this video, go back in your charts, pull up the NASDAQ charts. This today, at the time of this recording, is the 17th of June 2024. Go back to your chart and look at it yourself. Do these markings yourself. Look at past data, past months, past days of the week that this has happened, and outline it, annotate it, try and frame an idea around it. And with that, that is how you get better. That is literally it. By looking at past data and looking at the charts in real time, that is how you gain experience. That's how you put on a thick skin for the market. That's how you put on, in terms, it's kind of like going to the gym. You go to gym repeatedly, day after day. You rest, you come back, you do reflective, you rest. When you go to gym, you come back, you rest. So think of resting as journaling and back testing. Going to the gym is actually forward testing, looking at it in real time, watching the YouTube videos, actually learning. So going back to rest, going back to look at these things on your own. Don't just watch these videos and think that, oh yes, it's this and that, and boom, you've gotten it. You are wasting your time. Watch the videos, maybe watch a couple of times, take down some things, because some things will probably fly over your head. Take down some notes, go back to your own charts, go to tradingview.com and look at these things for yourself. Look at them and annotate them, draw them out, do the markings. Oftentimes I don't have these levels on my charts because I can visually see them. I don't have this much, oh, market structure shift, fair value. I'm not drawing this out on my chart. I can visually see this. If I hide I can see this. My eyes are trained to see this. I can see the liquidity here. It's traded through. I can see the favor. I can see this and trade on it and execute on it, because I've trained my eyes to see these things. But I've had to do these drawings and shortcuts for the sake of teaching and building on your understanding. So it's easy. So I'm walking you through, I'm holding you through these infant stages. So with that being said, hopefully you found this insightful. Hopefully you found this inspiring as well, to see things through my point of view and how I really view this market for what it really is. And yeah, and I look forward to meeting you in the next video. Hopefully you found this insightful as well. Thank you very much, and we'll talk soon. Bye for now.